So let me tell people the background to this. I previously built a business called Web Asset Management, WHEB Asset Management, which is a sustainability themed equities business, which today manages somewhere in the region of $1.3 billion. It's kind of long only, average 60 to 80 public equity positions. They're very thoughtful on ESG and sustainability matters, and that's where I spent a good chunk of my time until 2014. But I had noticed that some of the best performing investment vehicles in the world that I knew were closed-ended vehicles. So family offices, for example, I've been on the board of my own family's investment group, Cabinet Holdings, since my early 20s, and also some of the listed investment trusts, the permanent capital vehicles that we know so well, the kind of Rothschild Investment Trust, RIT, Capital PLC, Caledonia, what used to be known as British Imperial. A lot of these vehicles have performed incredibly well on the basis that often they're more concentrated than their open-ended peers. They're able to embrace illiquidity. Because they are closed-ended, they're able to flex their asset mix according to how they see the world. And often they have people involved in them, backers who have a great network. So if you look at, particularly RIT Capital, whose former chief executive, Graham Thomas, was my original partner and remains chairman of our investment committee in Menhaden. RIT was really a combination of fantastic risk management in conjunction with Jacob Rothschild's world-class network. And as people will know, it performed incredibly well over decades. So I, in 2014, went to Graham Thomas, as he left RIT, and said, look, why don't we set up an investment trust along the lines of RIT, but slanted for climate and the environment, which is where I had spent my career building Web. What we really decided was, raise as much as we can. In the end, we raised about £80 million at launch. And if you could jump ahead a slide, please. We launched in July 2015, and this was the team that we've had for a long time. So there's me, there's Graham, who's ex-RIT, Luciano, who's on this call, is our chief investment officer who leads portfolio management. Luciano joined us about a year in, and Teddy Pivers joined us about a couple of years after that. If you jump ahead, please. Whilst the board is independent of us, they outsource management of the portfolio to us in a separate management company. And Luciano is a former credit investor, 15 years in Deutsche and then at Barclays, and so has always had the mantra, return of my capital first and then return on my capital second. So we really, since Luciano joined, sought to pursue a kind of Buffett school quality and value approach in a concentrated portfolio. And that's a strategy that we worked up in conjunction with this board. So our former chairman was Sir Ian Cheshire. Ian ran B&Q parent Kingfisher and was a kind of titan of the FTSE 100 and is now a big league non-exec in various different positions, been in Barclays as a senior independent director and so on. And Ian really understands this resource efficiency theme. Ian, alongside Stuart Rose, who at the time was chief executive of Marks and Spencer, launched a massive energy and resource efficiency or green industries wave of investment within B&Q, and it paid off handsomely, more than they'd expected and forecast. And Stuart Rose's program at Marks and Spencer was entitled Plan A, because there is no Plan B. So we wanted someone who understands this green industrial theme, which I'll talk about in a moment, from a business perspective. Howard Pearce has run public sector pension funds. Soraya Chabarek runs CQS, which is Lord Heinz's, formerly Lord Heinz's investment business. And Barbara Donahue ran the family office of the Fisher family behind Gap, the clothing brand. If you could jump on. And again. So the idea is to run a multi-asset long-only strategy, with an emphasis, as I mentioned, on capital preservation, which is why we have a CIO who comes from credit investing. And so looking for a really good balance between risk and reward, but investing across public equities, and that means blue chip, developed market, global equities. And you'll hear in a moment, we've got a cluster of big tech, Google, Microsoft, Amazon. We've got a cluster of North American freight railroads, Canadian Pacific, Canadian National. And on the private equity, private credit side of things, again, we also pursue this quality and value approach. So we only invest in opportunities that are underpinned by solid assets with cash flows and where we can co-invest with the best in the business. So we've co-invested now a number of times with KKR's infrastructure team. We've co-invested with private equity and real estate player Apollo, the big New York firm, with Perfin Apollo in Brazil, which is an infrastructure investor, no relation of the previous, with TCI and so on. And this is where network comes in. We're able to invest on preferential terms each time with these private equity and private credit investors as a minority co-investor, often with no management fees or very reduced fees in deals that are really blue chip. And that's worked super well for us during the last 8 years. We've had an unblemished track record in our private equity, private credit positions, which currently make up approximately a quarter of the portfolio. I can't imagine it would ever be more than 40 or so %, but it has been up at that sort of level in the past. Had a slew of exits and it came down to around 10% of the portfolio. But the bar is higher for private deals than it is for publicly traded ones. And we run a concentrated portfolio, so 15 to 20 positions, and we've never had more than 20 positions. And the highest conviction ideas have been as much as 20% of NAV. At the moment, the highest positions are low teens and very low turnover. So we're long-term investors. We buy stuff with a very patient long-term outlook, and we like to hold things for kind of 3, 5 or more years. And whole quarters go by where we don't do very much in the portfolio. So we're thoughtful and patient. If you could jump ahead. We're thoughtful and patient, and I guess that we're going to come to a Venn diagram in a minute. 3 overlapping circles. The first of those circles is thematic. We are interested in the theme of resource efficiency. So if your company manufactures microwave ovens, which use significantly less electricity per unit than everyone else's, then that's of interest to us. So that's a really broad way of saying green. Now, Graham Thomas didn't want to have a narrow mandate. When we first discussed this, he didn't want it to be called green or climate. So we thought energy and resource efficiency give us a very wide lens through which to look at this theme. And if we consider what the green industrial revolution is really about, it is about the much greater efficient use of all resources, energy, raw materials, water, and moves towards a circular economy where stuff doesn't get wasted. And companies that take that theme seriously not only save money and have a more efficient and lean business model, they're typically better managed businesses, they're typically leaner, and that is now becoming clear in equity returns. Businesses which are thoughtful about their use of resources in a world of accelerating disruption and in a world in which competitive moats are under siege and so on. Businesses which are strategically nimble and think about the big themes of the day typically are performing better in terms of their share price performance. The second of those circles in that Venn diagram is really quality. And what we mean by quality is high entry barriers. Companies that benefit from strong competitive positioning and therefore have pricing power. The regional rail freight monopolies in North America are a prime example. Or the big tech players. We like companies which are protected in that kind of an era that we live in. And then value, although valuation might be a better word to use, but we're obviously mindful about the valuation at which we enter these businesses, and we're very, very thoughtful about that aspect. So this is a kind of concentrated portfolio, Buffett school approach to investment, with an emphasis on value and quality, and considering the world through this lens of resource efficiency. You might say it's a kind of climate slanted portfolio, and it's worked really, really well. I mean, we'll get to performance, but we are, according to the data put out by the Alternative Investment Companies Association, the AIC, we're the #1 best performing multi-asset or flexible asset class investment trust in the UK market over 1, 3, and 5 years. We're also the #1 best performing environmentally slanted investment trust in the UK market. We've produced performance of somewhere around a little over 10% annualized net of costs for more than 8 years. So from an investment management perspective, it's working exactly as we wanted it to. Should we jump to the next slide? I think this kind of speaks for itself. In terms of the themes that interest us, digitalization, you can read for yourself, sustainable infrastructure and transport. It's quite difficult to slice and dice, and we're not a top-down investor. We don't consider that we need to seek out a deal in water, for example, if we don't have enough. We don't build the portfolio that way. We build from the bottom up. But for the sake of explaining what we mean by energy and resource efficiency, well, looking at the positions we've considered in the last 8 years, we land on these 6 themes: industrial emissions reduction, water and waste, clean energy, obviously, and environmental reporting. We've made a couple of successful private equity investments in clean energy. We worry a little bit about the commoditization of power that is produced at zero marginal cost, and we wonder what energy prices, or electricity to be specific, prices are going to do in the coming years when you have a growing renewables capacity where there is zero marginal cost. We think that could produce downward pressure in a market which is fundamentally commoditized, and so therefore clean energy is less appealing to us now than perhaps it might have been. Should we jump ahead? So these are our largest positions, and what I thought it might be a good idea to do would be to have Luciano join us and just pick 1 or 2 of these positions to give you a feel for how we think about equity selection. Now, these are all long-term holdings for us. We've held Safran for 8 years. Airbus, with a bit of a break around the time of COVID, we've held Airbus also in 2 stretches for 8 years, and also the big tech. But before I ask Luciano to join us to talk about some of those positions, or 1 or 2 of them, I'll just touch on the private investments. Obviously, this only shows existing portfolio positions. We've exited our previous 3 co-investments with KKR with mid to high teens IRRs. What we've sought to do there is build relationships with investment managers that ordinary investors can't access. The relationships with firms like TCI, KKR, Apollo, TPG, and so on, such that we are considered a useful and friendly and hassle-free sort of passive or semi-passive, but value-adding minority co-investor. And that's worked really well. We've got access to deals in Menhaden that most investors couldn't access on terms which almost no investors could access. And that was always the thesis here: really high quality risk management in a concentrated portfolio, and using a network that I in particular have spent a lot of time building to get us into deals that are really off market. So the TCI real estate fund, we don't pay management fees there. That is short duration, 10 to 12% interest of secured development loans in the primest of prime locations. TCI and their credit fund have produced long-term 11-12% returns for significantly more than a decade, and it's kind of a friends and family fund for people associated with the TCI hedge fund and Sir Christopher Hone, with a very high minimum. So we were lucky to get into that fund. Avantis and John Lang are both co-investments with KKR's infrastructure team, which has been probably the best green infrastructure investor in Europe for a number of years. And again, we get routinely asked to tag along in whatever deals they're doing. So on the private side, it's the same idea: high quality investments at the right price with a long-term outlook in a concentrated portfolio where there is a resource efficiency theme. And it's worked really well. If you look at the history of the last 8 years, the private investments have performed in line with, or a little better than, the public equity positions. With that, I'd love to get Luciano to jump in and maybe just pick 1 or 2 of these positions in the public equity portfolio, and just maybe give 2 or 3 minutes on the rationale, and perhaps Microsoft or Safran.
If you look at the list of the names, the first thing that I would mention is that they are all monopolies or oligopolies, so very difficult to disrupt. There's 2 types of companies that we invested, like the ones that basically you will see names like Canadian Pacific, Canadian National, Ocean Wilson's, Vinci, where effectively we own infrastructure, almost impossible to disrupt, railroads, airports, and ports, and then the rest is, and obviously perhaps we can include some of the privates into that category as well. But the rest are basically companies where there is operational leverage, companies like Airbus, Alphabet, Microsoft, Safran, and Amazon, companies where there's massive operational growth and operational leverage, and you know, perhaps, you know, there's a higher risk of disruption, but the payout is also more skewed on the upside. In terms of the returns, we think that all of them offer IRRs around, you know, in the range of, you know, 9 to 11%. In some cases higher, like in the case of Airbus and Alphabet, but with very limited risk. We always try to limit the downside risk on all of them. And yeah, we think the portfolio is very well placed for the next 3 and 5 years. So probably, Ben, you should go back and talk about performance.
Let's jump ahead. Well, I suppose the big topic is the share price. You know, from an investment management perspective, you know, our trajectory has been great. You know, we are producing investment performance. The inception figure is a little lower than the 7-year figure because our first year was difficult. You know, we had a bit of a mishmash in the portfolio, and we had a bit of a knock during the first 9 months. And then Luciano joined, and we developed the strategy that I just described to you, and it's been plain sailing since then. Our ambition is really long term. You know, we want to build an established kind of long-term investment vehicle that's well known in the London market as a safe place to put your money. You know, we want to follow the path of RIT or some of the other vehicles I've mentioned. The RIT started with under 40 million pounds in 1981 and compounded over a number of years, compounded its way to scale with a little bit of M&A on the way, and it's been a huge success story. And you know, that's kind of what we always set out to do. And the part which we really control as investment manager, we've done very well, which is the investment performance. You know, we have you know, we've done what we said we'd do, and we're really committed, and we're tremendously aligned. You know, Luciano and I and members of our family between us own, you know, a little more than a quarter of the vehicle in terms of the shares. So the big issue is the share price discount to NAV. You know, we're trading at a, you know, fluctuates between a 30 and a 40% discount. Now the whole sector is trading on a discount. I think the average discount is north of 20% now in the investment trust world. But it's annoying, and we have a little bit of a buyback underway now, which people who are paying attention to Menhaden will know about, which has just started. We have a continuation vote next May. You know, we're optimistic that we'll pass the continuation vote. We have a good cohort of supportive, patient, long-term shareholders. But the discount's an issue, and you know, the kind of principal options that are out there for managing the discount, you know, take us in the opposite direction to the one which we think makes most sense, which is to compound our way to scale. And of course, scale means greater liquidity in the shares, and greater liquidity in the shares and greater scale hopefully means a narrower discount. You know, and so anything which takes us backwards in terms of total NAV is unhelpful in that regard. And that's why you know, the various kind of mechanical options that have been discussed, and on these kind of webinars we always get those questions, have ultimately been dismissed by the board who decide on such things, apart from the ongoing buyback, which is a pretty new development, because we really just want to get our heads down and grow this vehicle over time. And for long-term investors, you know, you're able to get into a Google and a Microsoft and, you know, kind of world-class private equity co-invests at nearly a 40% discount with an underlying ongoing performance north of 10%. And it's not an expensive vehicle. If you look at the benchmark of total expense ratios across the sector, we are not among the most expensive vehicles. You know, we have a total expense ratio of somewhere around 1.8, you know, and that comes down with every year of NAV accretion. So I guess we're on this call to encourage you all to, what was the expression my father once used? Back up the truck. Shall we go into questions? I don't know if there's another page after summary, but I think not. Yeah, well, I think we've talked about this. I mean, these are our exits. It's worth dwelling for a moment. You know, we've made good money on our private investments.
A lot of questions about the discount and what can or should or shouldn't be done about it. The question I had to start with, if I may, having those holdings in the large mega cap US listed equities, is the discount then the perception of the valuation of the private holdings? Is it disproportionate to your peer group? And it feels, if with the publicly listed holdings you have and the size of those companies, doesn't seem to make sense. It certainly doesn't quite match up there. Is it the private holdings that are attracting the discount? I don't know if I expressed that very well, Ben, but
no. It's a good question. I don't think the private positions are sort of. I think it's neither here nor there when it comes to the discount. I think the discount is a function of size. Now, I think we're a smallish vehicle with 150 million of capital and a market cap, 35 to 40% beneath that. And there's consolidation in the wealth management industry, and therefore the size thresholds at which wealth managers and independent financial advisors and so on will start looking seriously at this investment trust keeps on going up. So I think we know that by that logic, we need to compound our way to scale. We need to find a way to get big, and that I think that is our biggest issue. I mean, the secondary issue is the fact that we have this block, of kind of family backing. This is to some degree a Goldsmith backed vehicle. It's really a Goldsmith and Luciano Suana backed vehicle. He is also the 4th or 5th largest shareholder, and our chairman Graham Thomas is a significant shareholder, and then there's me, and then there's our respective family, and there's 27-28% of the shares. And so I think people wonder what the catalyst might be for making a quick buck on this, because that looks tricky as well. But I think fundamentally this is about size. I think if the private positions were less than 10% for a good chunk of last year and beginning part of this year, and it didn't seem to have an effect.
Okay. Question about Airbus. Why was Airbus selected over other aviation companies, say Boeing? Did you see risks in Boeing back then?
Luciano, do you want to jump in and talk about Airbus briefly and comparisons with Boeing?
Yeah, there's many differences in terms of. First, it's just to mention that basically, effectively, it's a current duopoly, right? There's just Boeing and Airbus, and yes, there's some competition from the Brazilians, but just for very small planes. In terms, Boeing has focused on profits for many years, and they neglected technical aspects of design, etc. And the infamous documentary on Netflix, if anyone wants is interested. And the planes are basically better. The Airbus planes are better, and the company's better run. And they are focused on product rather than just profitability. But for the next few years, we see a very interesting, effectively this 10 years of production with the current order book that they have, and they're going to increase production, and at the same time they're going to increase their margins. And we see that Airbus is a very interesting opportunity where we see IRRs higher than 15%.
Okay, next question is about portfolio turnover. You described a very low portfolio turnover, but typically, when and why do you sell?
Well, this just give you an example. We had 20% of our portfolio was Alphabet, and then we trimmed to 10%, and just to mention that half that amount was profit. We had a very good run with Alphabet, but then we had all the news about large language models, and that became a bit, the ranges of outcomes basically widened, and then we decided to basically to decrease the size of the position because it was effectively very, very big. We still think that they're going to do well, but there was, you know, we didn't need to have 20% of the portfolio in Alphabet. We still think that it's a very good company with, and they will do very well. But when we see something that changes our perception of the risks attached to the company, we will act.
Next question is about capital preservation, something a term used earlier on, Ben. And what does that mean in practice for how you run the trust?
I mean, that means emphasizing high quality in everything that we do. So we don't invest in anything which is binary in potential outcome. You know, we don't do venture or distressed credit or so small cap investing or none of that. We just invest in solid assets with cash flows that we can predict with some degree of comfort. We are a very conservative investor in the way that we allocate our capital, and that is how we go about you know, pursuing a capital preservation approach, and that is, you know, that has rung true during the last 7 or 8 years. You know, we haven't lost money and stuff.
I would just add that basically, like we have to look at what the end game is going to be in each sector, right? So in the case of Microsoft, is clearly going to be the winner in cloud. The same with like the infrastructure companies. You know, there's onshoring in the US now, so the railroads will do very well. It's going to be a story, until very recently, is the story of margin increase, margin growth. Now it's a story of volume growth, and so we try to see what can go wrong in each sector, in each company, and then we scale the positions in as a function of the risks and the returns. And I think it's on, you know, it's gone very well until now.
Final question for me then, please. They said numbers have all sounded very positive. Do you feel it under the radar, certainly amongst the retail investor community, maybe a name that's not so well known? Is that being something that contributing to the discounts? Is that something that's been holding you back, perhaps?
Yeah, I think that's a really good point. Like I mentioned earlier, we had a pretty bad first year, 2015, which was sort of a shock for me personally, you know, to launch this thing and immediately have a down year. And so during the period in which we've been rebuilding the NAV very successfully, we've grown the NAV at more than 10% annualized net of costs for the subsequent 8 years since that first year. I was in sort of an apologetic crouch and didn't want to get out there and shout from the rooftops about Menhaden. And I think probably added to that is a certain amount of complacency on the back of the more than 25% of the shares that are in our own hands. You know, and therefore, you know, do we really need to bother? You know, let's focus on doing what we do well, and the market will find us. And so, what's changed in the last couple of months, in terms of the board and our advisors at Frostro and our brokers at Numis and ourselves, we've decided to pursue a buyback, which people will have seen, and we've decided to get out there and do things like this. So our diaries are now full in the next 3-4 months with trips to major cities in the UK, Manchester, Birmingham, down to the West Country, Liverpool, and also various events and webinars and so on, just to get the word out there for free and to get some publicity as well. We've been tipped in Money Week 2 years in a row, but we want to do a load more of that and get people to know what we're about, recognizing that we're small, and the best thing we can do to narrow this discount is just to keep growing through compounding.